Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. Very excited to have everybody here. We really enjoy this process. What we're trying to do is help people create a more successful retirement. Whether you're 20 or 80 and already in retirement, a lot of the things we talk about are how to kind of enhance that retirement, make it financially safer as much as possible. And so we focus on kind of retirement planning and the aspects around that we think are important, the asset management, trying to make money with our money. And then, of course, the tax management also, just trying to keep that, within reason. So this is a question and answer show. There's a couple different ways you can send in questions. We do have a chat window here that you can see. You can sign into your YouTube account and just chat in a question if you have it. Or you can email to asktom@talkmoneywithtom.com. And Eason, who's here also, is one of our advisors. He'll be receiving those emails. And those emails you can send anytime. Matter of fact, we get emails during the week pretty regularly, which definitely helps. We can think about the questions a little bit better. But um, and so those are the two ways. And then ongoing, if you'd like to get more information, you can subscribe to the channel. You can send us your email address. We have an email list that we send out, different content that might be useful to you. And if you'd like to talk to us directly, maybe something custom for your situation, you can go on our website and hit the book appointment button and just have a 30-minute, video or phone call appointment with us, and we can see if we can help you. So those are the parameters. Really looking forward to the show today. I always like to start off the beginning of the show just talking about what I saw as important in the stock market. So, a piece of a good, successful retirement, in my opinion, is the ability to make sure that the assets that you've accumulated or going to accumulate it if you're not there yet are well positioned, and you have some good philosophies around that. So, one of the key pieces that I talk about all the time is to be able to identify the good things that are happening in the stock market. Those are much more difficult to find. The negatives are easy, they're all over the news. And if you only read those, you'd probably never invest or you'd underinvest. And so getting a balance between the positive and negative is critical. And so I try as much as possible to present a lot of the positive pieces. And this week is very fascinating because, it's doing very well. We've had Thursday was the best day we've had since March. We're up a bunch again today. So things are really, really moving. And so the question would be why? Well, the reason it's going up has a lot to do with all of the positive things that we've been talking about here in the recent past. So, for example, earnings were starting to be released this week, and they were pretty good, better than expected in a lot of cases. Got a long ways to go on earnings, but the key situation right now that we're looking at with earnings are we have this supply chain, issues. We have tight labor market, and those are causing some inflationary problems. But how does it actually impact the company earnings? So that's what we're going to find out. These are some of the best run companies in the world. Let's see how they handle this situation. So far, earnings have been good, and that's been pretty useful. The next thing that came out on Wednesday actually was the unemployment report. So this is first time unemployment claims was the lowest it has been since the pandemic started. So that's critical, and that's a good thing that's happening. People aren't getting laid off as much and those types of things as the economy continues to grow. And then also on Wednesday, there was a press conference talking about the supply chain. And so they're working on programs to try to help that supply chain move more efficiently. And they're using kind of the Amazon example. So Amazon got hit very heavily with lots of orders right at the beginning of the pandemic. And they ended up switching over to a 24/7 model where they're running the business 24 hours a day, 7 days a week. And so now they're trying to take that model out to other parts of the supply chain to catch up. So what happens here? This is a lot like the end of World War I and the end of World War II, where there was this huge demand as everybody came back, but the supply wasn't there. And so it creates these inefficiencies. In both of those cases, those work their way out. But what they're trying to do here is just at least temporarily get the port in Los Angeles to run 24/7. Several big companies like UPS and Federal Express and Walmart all agreed to a 24/7 model also. The market moved quite nicely on that information, so that was good. And the big piece though that has to happen there is we have to have people. So it's one thing to put that into place and to have this structure and decide you're going to go 24/7, but the other issue that's happening is getting people to take the jobs. And so there's two main things that need to be dealt with to get people out to take the jobs. One is the virus, and the second, the fear of the virus, and the second is childcare. So, and those are somewhat related. The childcare industry is struggling because they can't get enough people to come out and help in these, daycare type situations and what have you. And so we've got a scenario where people are staying home for that purpose. So a couple things that are happening, I think, that are positive here. Number one is if you look at the charts, the number of new cases of the virus is dropping pretty nicely. Actually, it's coming down pretty dramatically all over the country. So hopefully that starts to make people feel better about coming back to work. We also have this new pill from Merck, which is an antiviral pill. It is not yet approved, but it looks like it's going to be approved pretty closely. And so far in testing, it seems to have done a pretty good job with somebody who already had just caught COVID, take the pill, and less chance that they end up in the hospital. And again, if those things start to come out and they start to work and they start to get some press, that again will make people feel more confident to go work at a child care center or go back to work at the port for that matter. And so I think these are things that are good, that are happening, that are starting to develop. And look, let's face it, overall, we're probably going to figure out the supply chain and the labor issues. This is just this anomaly that's happening. How long it takes, that's a big question, but it's going to happen at some point here. And so the market, again, is always operating on a future look. And so if the market starts to think that those things are starting to get to a better spot, you'll see it move, which is what we're seeing. One of the big drivers today was the retail sales numbers that came out. So you have this scenario where, September sales numbers were much better than expected. And again, one of the things that you got to be careful of when you're investing is to bet against the American consumer. Very powerful group that continues to come out and buy and spend, and that helps the economy here. And another thing I wouldn't bet against is American companies. These are some of the best run companies in the world. We just been through some really crazy times with all the work from home and everything. And these companies, for the most part, have done really, really well. So, when they're faced with supply chain issues and different labor issues and possible inflation, I think they probably do better with that than we think they might do. These, again, are some of the best companies in the world that are, especially these big ones that we're investing in. So that's important. Last piece that I think is important to understand that might be driving the market upward here is just that we've got three pieces that the government is dealing with: the debt ceiling, the Build Back Better program, which is the reconciliation bill, and then the infrastructure bill. I think all three of those could be taken care of here in the short term. The debt ceiling was moved off to early December, giving room for them to get the Build Back Better program together, add the debt ceiling to that, which they seem to be more willing to do, increase that so that maybe we have enough to get all the way through to December of 2022, and then sign the infrastructure bill also all at the same time. So think about all three of those could come along here in the short term. And let me tell you, first of all, that debt ceiling going out another year would definitely make the market excited. So that's really, really important. The two bills being signed would cause some fear of inflation because of the stimulus effect of those. But I think that will probably be offset by the fact that those bills are spread out over an 8 to 10 year period. And I really think that that's going to moderate some of the inflationary pressure that we're seeing there. So anyway, these are the things that I'm seeing this week. Those positive pieces that we've been talking about for quite a while are playing out here. The stock market only dropped 5.9% from its high to its lowest point here, early September to early October. Even with all the bad news and the debt ceiling issues, what have you, that are happening, it should have been down more. That just shows you the power of this market. And now we're less than 2% away from the all-time high, which I think we're above the 50-day moving average, which again, I think is something that will be a catalyst that we're probably seeing today, really, in the stock market. So really, really good time to be an investor in the market altogether. And I think, we'll see how this plays out, but keep some focus and some balance in your overall view of what's going on. And I think that would help you and should certainly long-term help your retirement out as far as that goes. So anyway, that's what I saw this week. Looking forward to, really talking to you about this again next week. All right. Let's go to the questions. I know we got some questions this week too, and see what else comes in as we go here. So again, it's never too late to send in a question. If we, for some reason we don't get to you right at the end, we'll answer it next week. But feel free to send in anything as we're going here.
Yeah, so our first question is Social Security, the cost of living adjustment was 5.9%. Should I be worried about inflation? How does it affect my retirement and my expenses?
Yeah. So Social Security had the highest announced the highest increase in their cost of living increase at 5.9%, highest in the last 40 years. And so that's a good thing in a way. Unfortunately, the reason they're doing that is because the basket of goods that they look at have increased by 5.9%. And so it's a little bit of an offset, right? So, hey, you're going to get more money, but it's probably going to cost more, the grocery store and those types of things. So, but the nice thing is that we're going to get more money. And that's super important because all of those colas that we deal with, the cost of living increases, the bigger that base is, the more it grows. If you get a 1% next year after a 5.9, it's a good thing altogether. I think it's really a nice situation as far as that goes. But it does show that there's an inflationary pressure. And so, how does that affect the stock market, right? Which is the other area that might be important to you, in your retirement or if you're heading towards your retirement. Um, Higher inflationary periods. Sorry, let me get a drink here. Higher inflationary periods are um, are kind of interesting. So, if you I saw a study just recently that was very fascinating to me, and it showed that really the worst periods for the stock market is when inflation moves quickly. And so if we look at the 10-year treasury, when it jumps in a fast fashion versus a more even fashion, which makes sense. If you look at a company that's trying to deal with the products and the things that are coming in, you know, having your inputs jump up in price really quickly before you can really increase the prices of your product, and that it can eat up some of the earnings as far as that goes. Excuse me, got a little bug. And so overall, I think this environment will probably not be quite as inflationary as we're seeing here now. That will probably slow down. The Federal Reserve has been talking about 2022 being a much more normal year. So we'll see how that plays out. Having said that, the Federal Reserve is saying now that they think some of this transitionary inflation will be more less transitionary than thought. So it's hard to tell exactly what's going to happen. It's been a long time since we've been through a pandemic and a reopening. Um, but it's a concern. It's something to think about. It's something to watch. But again, trying to project what it's going to do and then react to that hasn't been working right now. You're better off watching how this plays out, setting up kind of a broad-based portfolio that can cover all the different bases, and then react to those situations. So if inflation truly does come, because we've been talking about inflation since 2008, it hasn't come yet. This year's inflation is really a result of a reopening, a supply chain that's been closed down, and the fact that we're coming off of a last year's numbers that were very low, right? So we'll see how that plays out. So how much happens next year will be a much more interesting piece to me. But just watch the price, watch what's going on in the market, and we'll be able to tell and listen to these earning calls to see how much impact we're seeing of inflation on the price. If we don't know what the demand elasticity is either, which just means that if a company can continue to increase its prices and still get the same amount of sales because there's so much savings on the sidelines and so much pent up demand to buy things, then their profits could stay the same, right? Theoretically. So, those are the things we have to see yet. We don't know. And again, I wouldn't bet against the American consumer and I would not have bet against the American companies to be able to figure out how to do this. But if they don't, we'll see it. We'll see it in the price and we'll react to that and deal with that and figure out which companies can do better than others, in that type of environment. But it's a good question.
Where do you feel like wage growth kind of plays into inflation? Because I know wages are a very key component of it.
Yeah, wage growth is more permanent to me. If you go from $7 an hour that you're paying everybody to $10 an hour, and then the labor market picks back up and people start applying again, you're probably not cutting everybody back down to $7 an hour. And so, that's where the more permanent portion of inflation plays a role. And long term, it's the one thing that seems to bother the economists and the different stock market, people the most, is this concept of a tight labor market, which ironically we have now, even though we have, lots and lots of people unemployed and lots of job openings, we still don't have many people actually taking these jobs. And so it is an issue. I think it's probably the biggest issue of all the different things, and maybe one of the hardest to actually answer. Long term, we'll answer it through automation, artificial intelligence, robotics. I'm telling you, these companies aren't going to sit there for the next 10 years and just hope for people to come out to work. They'll find ways to make their products, because as wage raises, it just brings in, like one of the things we saw here in California, when they went to a higher minimum wage, is all of a sudden you started to see more of these kiosks. Like you go into McDonald's and you order on a kiosk. They took those all out after the pandemic because nobody wanted to touch anything. But that's that type of stuff. But the idea was that if for that much money, hey, we can get this kiosk, which is more expensive than paying somebody a cheaper minimum wage. And so there is some replacement that's going to happen here as far as that goes. That will be an issue. I don't know that that's a good thing, honestly, because people need to work. But it seems to be a trend that's going to happen. Factories are becoming more automated, and I think that's going to continue. We saw a lot of big outbreaks in these meat packing plants in the Midwest, for example. I'll bet you there's a lot more automation that comes into those places, as we go forward here. So wage is a big issue. We'll have to see how it actually plays out.
Awesome. So when it comes to financial planning, should I just have like kind of one number that I use as my general expense, or should I kind of break it out into different factors or separate expenses?
Yeah. So let's just say, you get everything together and you say, I need 100,000 a year to live off of, or 50 or 75, whatever it is. And, so you can run a financial plan with just that one number, that big number. We tend to break things out for a variety of reasons. So we break out healthcare related issues because they grow at a faster rate than inflation. So how much you're going to pay, let's say you retire before 65, so how much you're going to pay for your private insurance, and then how much, Medicare is going to be. Both of those are growing at higher rates of inflation, so we generally break those out. We will break out other pieces, because they're lumpy, like buying a car every 10 to 15 years. We generally break that out separately, pick a dollar amount, and that just kind of, it's better than annualizing that, in my opinion. Just makes it cleaner, and get to see how that works. We also, sorry, getting some. We also tend to break out things like travel, because um, it's just fun. I mean, it's really great for the clients to be able to see, hey, it's 20,000 in travel or 5,000 travel, whatever it might be. Kind of gives them a budget and they can think about that. Where if it's just buried in the overall number, there's pros and cons to having the overall number or what have you, but this has worked really well for us over the years. We will also generally break out, hearing aid and dentistry as separate pieces, just to kind of make the point that they're lumpy. They don't happen, every month or anything, but they generally have a chance of happening inside of somebody's retirement. And I guess the last thing we'll really break out a lot might be long-term care, just in terms of as a potential expense, because you might need 100,000 a year, but if one of you goes into long-term care, you're going to need a lot more at that point in time, whether that's home care or skilled nursing care or what have you. But so those are the things that we generally break out. And I think that it's worked really well. It creates a conversation that you can't really have when everything's buried into one number, as far as that goes.
Yeah, and another number that we tend to break out is if you're funding someone's education, whether it be a child or grandchild, Education is another one that inflates much higher than just the regular base living
Yeah,
expenses.
I can't remember what the number is right now, but the average cost of college has been growing at some, I think it was 7 to 9% or some ridiculous number. So yeah, exactly. That's a good point. And also we generally can fund those with some different accounts, like a 529. So we if we break that out from the overall number, then inside the plan we can also identify that 529 plan to accomplish that goal, which you can't do if it's, at least in our program, if it's all smushed into one big number, right? So yeah, that's a good point.
Yeah, and so this is kind of a little bit stepping back to the kind of fundamentals of retirement, but what are kind of like the basic factors that you, or like inputs that you for figuring out retirement?
Yeah, okay. So, on a very basic level, one of the most powerful ways to look at retirement planning is just, kind of imagining this big asset base that you've got in your retirement, either now because you're retired or you want to have, if you're not retired. And then what I look at is kind of what are the inputs? What's coming in? I call it from the top. So Social Security would be a great example, or rental income that might be coming in, or pensions, or any of those things. So those are all inputs on the top. And then what are you pulling out the bottom? Travel and this, basic living expenses and medical costs and all those. So the whole financial planning is that inputs, assets, outputs, right? That's it. And the planning process is just to determine whether there's a balance there. Is that do those three pieces work? Are there enough assets? Are there too much withdrawal? Is there not enough inputs that are coming in? Or how do we maximize these? And the planning process is just that: inputs, assets, withdrawals. Now, there are other aspects to that that are kind of interesting, and that has to do with really just the number of years. So, if you're not retired yet, how long do you have to put money in? So, that's an aspect that we can actually change. Somebody comes to us and says, "Hey, we want to retire at 50," and it doesn't work. I can't get it to balance for what their parameters are, but maybe it works at 55. So, that's another aspect of like flexibility potentially, as far as that goes. Or we leave it at 50 and they try to stay more motivated to save more. There's some different things because you either have to save more or move the time off to make some of these work as far as that goes. So, somebody who is, in their 20s that wants to retire in their, say, early 50s, one of the challenges there, they're going to have less years to save, right? There's no doubt. And then they're going to have more years that they're going to be withdrawing. So if you live into your 90s, you retired early, those are the challenges that have to be met by that. So that person has to be very, very motivated to save a lot of money to make that work and to possibly even make sure that their standard of living after retirement is reasonable. So it's not so hard to accomplish. But yeah, those are some of the big parameters: just inputs, assets, outputs, number of years you can save, and then what age you retire, for example. Those are some of the big ones.
Yeah, and so like the basic factors that we can kind of change around is can we move your savings up? Can we lower your expenses? Or can we maybe give you a longer time horizon to
Yep.
if you're at the kind of edge? Those are really kind of the inputs that we change and try and help you decide on.
Yeah, I would say that there's a couple others, and some of them are more important than others, but maximizing Social Security is interesting. It'll add a couple percent to the probability of success if you do that correctly. So that's one piece. The other part is if somebody's really, really interested in retiring at a certain age and it's really not working, and they have some equity in their home and they're willing to move, putting that in there. Hey, we're going to move, and this is how much money is going to be captured out of that move. But what you're doing there is you're adding in assets that wouldn't be counted otherwise, because most of our clients say we're not going to move. So that house is worth a lot here in the valley, but essentially, if you're not going to move, then it's just a place to live. But if you are going to move, you're going to go to Arizona or something, you might capture a bunch of money that then just increases that asset base that you can withdraw from. So those are a couple of other things that can be looked at to see, uh, again, in a scenario that is a tight scenario or doesn't quite work without a little bit of maneuvering and thought. But those are the basics. I think it's really important to understand the basics of retirement planning. It just makes the conversation with your planner a lot more productive. The more you can understand the basics of how it works, the more that you have a chance of having a successful retirement. I think planning is a really critical part of this. It's something that we lean on pretty heavily.
Yeah, and another factor that some people do is, especially if you're part of the fire movement, is you kind of have a part-time job or some sort of kind of side income that you're doing on that you kind of the idea of fire is to be financially independent. So you're not tied to your job, but you still do something that maybe produces less income than your previous job, but it would still help offset that
Yeah,
loss of complete
and
expense.
and hopefully it's something you enjoy. You know, you like to knit and you end up working at the yarn store. You really like it. It helps to, bring some money in, pay some of the bills, take some pressure off of the assets. That's one of those inputs that's coming in as part-time work. Got a lot of people that have done that. Even people that don't need to have done part-time work just because, they like it. They want to go out and they like the social aspects of it. But certainly if you do need it, that could make a difference. Yeah, it's a big deal.
So our next question is kind of on ESG investing. So environmental, social, and governance investing. Um, I heard that ESG investing, I will underperform the market. Is that true? Like, I want to be a responsible investor, but I don't really want to put myself behind because of it.
Yeah. So what they're doing here is this is the old socially responsible investing. They've had a lot of different names, impact investing. There's a whole bunch of things, but the new concept is now called ESG. And so how does a company handle the environment? Is the E? How does a company handle the social portion, which would be the employees, the community that they're in, and then the governance. Really, what's the board look like? How does that company run in terms of a governance standpoint? And they rank all these companies now, and they can put these companies together just based on their ranking in these big baskets. You can buy them in an exchange traded fund, and we have ESG portfolios. And so in the old days, what was happening was that the only way you could get socially responsible investing was through a mutual fund, and you had a manager who had to dig through all of these factors to try to figure out whether that company should be in the portfolio or not. And now what's happened is we have these big companies giving ratings to all of the companies that are out there, almost all the companies that are out there. And so it's much, much cheaper to put that basket together just using those ratings. And that's a big difference. And then now we're using exchange traded fund, which are generally cheaper than the mutual funds also. So it used to be that with socially responsible investing, that we saw lower rates of return because the expenses were higher. So in other words, if I have one portfolio, my traditional model over here that has a 0.25% internal cost versus say, the old social responsible investing model that cost 1.25% internal cost, it's going to be hard long term to beat that traditional model with a 1% less internal cost. Now the internal cost differential is almost negligible. It's in some cases it's basically zero. And so that made a huge difference. And it also then allowed for more cash flow to come in. So we're starting to see, lots of money come into, a lot more money than there used to be coming into these exchange traded funds. And so they're being focused on these stocks that have good ESG ratings. And so what we have seen, at least, in our business, the ESG is holding its own. It's been, above the traditional, slightly below it, but I would not say that you are going to be making less. I would say actually, if there is a guest coming up here, you might be making more in the ESG side. It's one of the reasons why we put two giant pieces of ESG in our traditional model, which have been working out pretty well too. So, um, but one of the things that is important to understand when you look at kind of the screening that they do in ESG, a lot of companies that have higher ratings, better ratings, are a lot of growth related companies. And so overall growth has been outperforming, right? And there's some value been doing a little bit better this year, but if you look over the last 10 years, growth is outperforming. So in a way, what's happening with ESG has a lot to do with how growth is going to play out as a whole. But no, you can get very diversified portfolios, in my opinion, and have a nice situation. And at least in the last 2 or 3 years here in the portfolios that we've been managing, we haven't seen a drop off in return really at all. In some cases, it's outperformed our traditional model. So it's a good question. It's a question that gets asked all the time. You got a lot of people that are traditional investors and they're just barely kind of ESG investors, and they really don't want to go there because they're afraid they're going to make less money. The rest of the people that are already ESG investors are there just because of their belief system. They don't want to invest in these other companies. They want something cleaner, in essence, and that's okay too. And that's been a big part of our practice. So I would definitely not discount ESG.
So going off of that, you talked about how ESG is kind of leaning towards growth. Is there a way to kind of protect myself if I were to do ESG investing so I don't kind of overweight growth too much and kind of lose out on value too?
Um, Yeah, that gets to be a little bit difficult because of the fact that you do have a screen in place. And that screen, so for example, software companies like a Microsoft or what have you tend to be very highly rated because they really don't have a huge impact on the environment, for example, and whatnot. And they don't have factories and child labor, and these different things. And so you could end up with a concentration of, say, software companies and not some of the other things on the value side. And value generally has a lot of kind of older industry, which doesn't have as high of a rating. One way you can do that is to buy these more broad-based ESG portfolios. Like for example, Vanguard has the total stock market index, which is VTI, right? So that's the broad market. And now they also have that same index where they apply the ESG screen to all of those stocks. And that does pretty well, even in value run. It's not as tight on the ESG side. So it just depends on what your thought is. I have a lot of clients who don't care about the return as much as they care about the environmental impact. And that's those clients have been in social responsible from the beginning, back in the 80s when I started, and they knew they were going to make less money. They didn't care. And so they're still okay, even if it doesn't have the value and the balance. But those people that are kind of in between, that's where you can create a little bit more broad-based ESG portfolio. We'll incorporate a bit more value into it because they're kind of lowering the standards a little bit. So anyway, there are ways to do it in that regards. And so it's just a matter of kind of getting out there and figuring out how to structure that that portfolio correctly, and it's worked out really well so far.
So this is a fixed income question. In retirement, I'm looking at annuities. What are the pros and cons of them?
Yeah, actually, one of the things that's happening now, they're allowing annuities to be placed inside of 401ks, which is kind of interesting. So people will have an option to put their money inside of an annuity, uh, as well as or instead of the stock and bond market that they could have picked. So it'd be one of their options. And an annuity would be, the idea there would be you kind of build up a pension. Pensions have disappeared largely from the private sector. And so this would be a way to kind of create pensions again, where there isn't so much reliant upon the stock and the bond market. Um, but annuities are a contract, and there's you can talk about some generic pieces of annuities, like the difference between fixed annuity and variable, but there are a million little details inside that contract. So it's very difficult to answer that question without knowing some of those details. But on a broad-based, high-level look at it, a fixed annuity is just going to give you a fixed income for the rest of your life. So that's good in a way. There's no risk. The stock market goes as long as that insurance company hangs around. Most of them do. Then you still get that payment for the rest of your life. The problem is if I'm getting $1,000 a month today, I'm not going to be able to buy as much with that $1,000, say 20 or 30 years from now, later on in my retirement. So they don't keep up with inflation. So you got to be careful about putting everything you own in a fixed annuity. Um, but they have variable annuities. And again, these have more fluctuation with the stock market. They're modified in that regards. And there are some capabilities there of at least having some raises on that $1,000 of initial income. Um, but the details are important to take a look at inside those annuities and kind of analyzing them. As far as that goes, I have no qualms with using them. I will say that some of my happiest clients are clients with nice fixed pensions. So they know at least they have a chunk of their money coming in. But there are clients because they also have stock and bond investments. So I think it's the balance that really can be powerful. Anyway, it'll be an ongoing topic of conversation because this is brand new. This ability to invest in an annuity inside of a 401k has just become available. So we need to see, the details and, what are these annuities really like? What type of fees do they have? How is this going to work? Generally these are through insurance companies, and they're there to make business, sort of like a casino. So, you might not win on that, but if you get what you want out of it, and people still go to casinos even though we know we're going to lose because we get some entertainment value, correct? So, if I'm getting some peace of mind from a fixed annuity, and I know that I'm probably not doing as well as I might in some other areas because of fees or whatever, I still might do that because I'm getting peace of mind. And that's important in retirement also. So I think it'll be very fascinating to see how those play out.
Yeah, going off of that, annuities tend to have or higher cost than I would say other investment
Mhm.
vehicles, and so you're to have that fixed income, you're also giving up something a little bit. And there's a lot of complexity to them. So each annuity contract is unique, and so you have to be careful what you sign when you sign these contracts
Yeah.
because the surrender fee will bite you in the butt if you don't like it.
Yeah. Yeah, exactly. Yeah. The expenses are higher because they need to be. The insurance company is providing some form of a guarantee. So a fixed annuity, you're going to guarantee that fixed income, irregardless of what happens to their own portfolios. And so they have to get more money for that to justify that. Same thing with variable annuities. There's some modified guarantees in those. And again, those cost money. And so that's okay too. It's sort of like an insurance cost for a portion of your retirement income. But you're right, Eason. I mean, the details will be important to understand, and every annuity contract at every company could be different. So that's why there won't be a generic answer, good, bad, or different, because there are some, differences between how those contracts are written.
Yeah, and every investment vehicle has a purpose, and so you have to evaluate them on the individual level. You can't disregard one just because you heard some general rule of thumbs.
Yep.
So this is another question. Is there a point where I could be saving too much money, and are there any signs of this?
That's kind of interesting. Overall, I would say saving too much money isn't a problem. Um, I have clients that save a tremendous amount of money, and they have way more money, say even at the bank than they need, and different things like that. But it makes them feel good, and that's the key, right? I mean, there's life is not about all these little rules and rules of thumb and all these different things. And so I do think that's important. I have some oversavers as clients, no doubt. But it makes them feel good. And they, sometimes they put it out in the market, sometimes they don't, whatever it is. I would say you can oversave in certain types of accounts. And that's kind of interesting. So, for example, when we talked about college savings, you have to be a little bit careful of not overfunding those because you can only get the money out without the penalty and taxes if the money is used for college savings, for college expenses. Sorry, they're pretty liberal about what those expenses are, which is great. But if your kid gets a scholarship or goes to a cheaper school, you might not need it all. You can move those, to other kids or to other people in the immediate family, which I think is nice. There's some flexibility, but So there are some situations where I've seen where people kind of oversave in certain areas and certain vehicles. Uh, and but overall, hey, if I have 500,000 and I can save to 1 million and then save to 1.5 million, you're just making yourself more and more, secure in total within your retirement. Because again, the retirement is the asset base, what's coming in from the top in terms of incomes and what's coming out as expenses. So if you're saving more and more from those incomes, and that asset base is growing beyond what you need, you never know what you might need. Honestly, I mean, we've been living in a pretty nice world, even with this pandemic, at least financially. Overall, we've had some pretty good economic growth. This is nothing like the Great Depression or things that can come along. And that's why, accumulating assets is still a good thing. And so, yeah, that's a good question, though. It's interesting.
I think that you could be saving too much if you're starting to sacrifice your quality of life in
Oh,
some
yeah.
regard. If you're saying you're skipping out on a trip because you believe you can't afford it, but you can afford it, and stop visiting family or doing something social, I think that's when you're getting to the point of, you're saving a bit too much and you're sacrificing what's really important.
Yeah, it's very fascinating because high savers basically always worry about not having enough money, always. And so, yeah, they've got a potential trip they could take, and it costs some money, and they don't do it because it makes them uncomfortable. Um, and it's a tough one though. There's no great answer there because if they go do it, and they might not enjoy it as much. So if they think $5,000 is fine for a trip and they have one that's 10,000, they could do it. They have the money, but when they try to do it, they might not enjoy it as much, just because again, their number one concern throughout their retirement, and maybe throughout their lives, is I don't have enough money. I don't have enough money. And I've had people tell me that, when they definitely do. And that's okay. That's just part of the process. It's who they are. And so, yeah, it's a challenge to try to kind of get that balance once you actually do have enough money, to spend that. And I have found that people kind of stay with who they are, you know, prior to retirement. They kind of stay. If they spend a lot of money, they spend a lot of money. If they don't spend a lot of money, they don't. And they're both happy. It matter of whether they have enough money to make it work. But in both cases, people are pretty happy as long as they're able to pursue the way that they want to pursue, which I think is important. Okay,
So
good. You have want to give a wrap up here. We've got a couple minutes left. I want to thank everybody, so much for joining the show. These are good questions today. I hope everybody gets something out of this. Our intent here is to educate as much as possible. And again, you can subscribe to the channel. You can send us your email address if you want to get our email list. And you can visit our website. We have all of our videos on the website are transcribed if you'd rather read than listen to a video. And we have a book an appointment button on there. If you'd like to meet with us to find out, what your situation is and whether it's something we can help with, we would be happy to do that. So, I want to thank everybody so much for coming today, and I look forward to being able to see you again next week. Thank you very much.